Welcome to Real Estate in the Tri-State, where we talk about all things buying, selling, and investing in the Dubuque area. Featuring experienced locals giving you their real estate insight. My name is Rottler, and here is your host, my husband, robrottler.
Okay, welcome back to Real Estate in the Tri-State. Today's guest is a guy I'm just meeting right now, actually, for the first time. I'm really excited to get to know him and his story. We have looked into his story a little bit before today's show, and so I'm kind of excited. Just reading about some of the stuff he's doing has me pretty excited to interview him. So he is working to help high net worth individuals, real estate investors, business owners, and retirees grow and protect their wealth predictably and safely. As a financial consultant, health and life agent, he has cultivated a reputation for putting his clients first, no matter what. That's great. He prides himself on attending all client meetings without expectations or preconceived ideas to ensure that he is solving his clients' problems. Ladies and gentlemen, Sarry Ibrahim. Sarry, thanks for being on, man.
Hey, Rob, thank you so much for having me on and that warm introduction. I appreciate it.
You're welcome. You're welcome. Hey, you just want to get us started by telling us a bit about yourself so we can get to know you better?
Yeah, definitely. So I'm from Chicago, Illinois. I was born and raised here. I still live here. I live in the north side of Chicago, for those of you familiar with the Chicagoland area. Pretty much started working in the financial services industry in 2015. I started working for Allstate Insurance while I was doing my master's degree in business, and then worked there for a couple of years and transitioned into the healthcare field. So I was working as a Medicare consultant, helping retirees, people who were like 64, 65 years old, retiring, merging off of their employer plans and onto their own individually owned Medicare plans. That was my niche for a few years, just helping them make that transition, making sure everything made sense and it was the right fit for them. And as I was doing this, I started to build a relationship with these clients. And one of my clients asked me if I could help him with life insurance. And he mentioned, there's a life insurance policy, the cash value grows in it and you could borrow against it. And I had no idea what he was talking about, but I was like, hey, this sounds really appealing. It sounds like a really good idea. So I started to do more research on this, and I went to Amazon and I searched for books on life insurance. And I came across this book called The Bank on Yourself Revolution by Pamela Yellen. And the book pretty much talks about this concept. It's called the Bank on Yourself concept, which was invented by Pamela Yellen. And it talks about how you could take financial control of your life. And as I was reading this book, I was like, this is not only applicable to my Medicare client who I intended to help, but also this is applicable to anybody who pretty much makes money could use this book or this concept to help them. So then after that, there was like a part of the book that said, if you wanted to be a financial professional, I went through their training. It was like an 8-week rigorous training program. I'm a Bank on Yourself professional now, so I'm authorized to sell these products, to consult clients on these products. And then pretty much I started the company called Financial Asset Protection. It's a financial services firm located in Chicago, and we help clients in all 50 states. We help them build financial solutions with the core focus being on the Bank on Yourself concept. And that also led me to a further niche, which is the real estate niche. And most of our clients are real estate investors and real estate brokers. So we've kind of built out this financial practice for the specific niche, which is why I wanted to be on your podcast to share this concept.
Yes. And I'm excited to get into it. So Bank on Yourself, if a person's never read that book, how would you sum up that whole thing that has been a huge part in where you are right now?
Mm-hmm. Yeah. So pretty much the Bank on Yourself concept it's kind of a counterintuitive approach. It's the utilization of dividend paying whole life insurance, mainly for the living benefits, for the cash benefits in it. So what that means is when you have a whole life insurance policy, there's two segments to it. One is the life insurance, just like the title of it. And the second is the cash value portion of it. The cash value grows over time. You can access this cash value. This concept is also known as the infinite banking concept. So something that you can kind of grow your money and use it at the same time. You can leverage your money. So what we, for example, do is we'll have a client who's a real estate investor. They will utilize a whole life policy, fund it, grow the cash value in it. And then once the cash value is at a certain level that they want it to be, they can borrow against it and then use that to fund the real estate deal either in connection with as a down payment, or to finance the entire property, or to pretty much become their own mortgage or their own lender. So pretty much that's what the bank on yourself strategy is. And I kind of think that there's a reason behind it. The reason behind it is to take back control of your financial life. Instead of always having to rely on banks for financing, or instead of having to use cash for everything and then losing the opportunity cost on that, you can do both. You can grow your money and use it at the same time, utilizing the strategy. So you take back the interest and the control in your life. Wow.
Yeah, that's great. And normally I spend quite a bit of time on kind of the backstory and just philosophy in general. But for this, I'm like really interested, and I've never really heard much about it. So we might get a little nitty gritty here, if you don't mind.
Yeah.
So someone starts a life insurance policy. You know, they need a certain amount of money up front. Maybe they're paying a monthly payment to kind of fund that thing. And then there's a certain amount of money that they're, if they died unexpectedly or whatever, if the insurance were to kick in for the rest of their family members, they'd have $500,000 or $1 million. But how much of it can they actually access to use for, say, a down payment?
Yeah, awesome.
I mean, how do they build that up? Is it just the monthly payments that they're putting into this thing, and then, they have to do it for 5-10 years, and then eventually they have enough that they can borrow against, or what's the nitty gritty?
Yeah. So we always do a financial analysis with clients. It's us pretty much just asking questions, getting to know the client and their situation. So pretty much what we would do is we would sit with this client, of course it's virtual, over the phone or over Zoom. And then pretty much we diagnose what they're currently doing, their financial situation, what's currently happening. Are they W-2 employees? Are they full-time real estate investors? Is it a combination of both? Cash flow, current retirement income? Pretty much we're analyzing their situation right now. And then we'll make a recommendation after that as to what type of whole life insurance, and as to the funding amounts. Like you said, it could either be annual or monthly payments, and that depends on the analysis. Also, it could even be a single premium case. So that means like a client will take like $400,000, move it from one account into a whole life policy. And then what happens is two things happen. As soon as you fund the policy, one is you start building up cash value immediately. And the second is you have a death benefit. And then both the cash value and the death benefit grow every single year. So like I had one, to give you a specific example, one case, the client who's 7 years old, this client, and he put in $400,000 and he instantly had $375,000 in cash value that he could use. And then a death benefit, a life insurance amount of $580,000. So what he could do now is he could turn around and borrow up to $375,000 at any time without any questions, no underwriting at all. And he could use it for anything he wants, and his cash value will still grow. And then people are always like, how is that possible? How could you use your money and still have it grow at the same time? Well, the way it works is in this example that you have $375,000 here. When you, for example, if you want to use $100,000, when you go to use $100,000, you're not subtracting from 375, you're borrowing against the 375. When you borrow against it, your value keeps growing. And then now you have like a personal loan between you and the insurance company. It's a different source of income, a different source of loan. Sorry, not income, but a different source of loan. So now it's a loan between you and the insurance company. You're paying that. And while you're doing that, your money, the 375 is compounding and growing every single year, as if you've never touched it. So this allows you to leverage your own cash, grow it. And then, as mentioned, when you go to access that money, you don't have to qualify for the loan. The policy itself is self-collateralized. It's collateralized by itself. So you don't have to put up collateral. You don't have to, the insurance company doesn't need to check your credit. You don't need no other verification to make sure that you can qualify for that loan. So this puts you at an advantage, especially if you're in the real estate business and you're trying to fund your own deals. This puts you at an advantage because you never have to rely on banks or other lenders for financing. You can always go to yourself for financing. You're pretty much a cash buyer. You could buy deals in 3 to 5 business days from cash from yourself by borrowing against yourself without depleting your assets.
Wow, that's great. Yeah. So, I mean, getting rid of that financing contingency is a big deal. And that usually takes the longest time. It's a huge hurdle. Like that's a big problem for a lot of people. And in order to compete, in today's market with the low inventory, having a cash offer is a big deal for a lot of people. And so I guess talk about for the, I don't know if I want to say average, but just for the average Joe, how could they practically kind of get this off the ground and to a point where, they do have a sizable amount of cash that they can just use right away for, a real estate deal? I mean, do you guys, how do you get people to build that up? So obviously, if the 70-year-old has a $400,000 lump sum or IRA or something that he could roll into it, like that's great. But what if I don't have a large chunk of cash that I can roll into it? Do I just make my monthly payments, or how do you suggest people who are starting maybe at a little bit lower net worth or don't have a huge chunk of money to roll into it?
Yeah, you're right, Rob. Not everybody has, $400,000 laying around. Yeah, most people don't. Yeah. So yeah, definitely. You could. I started my first policy with $300 a month. I was putting in $300 a month, and the cool thing is, there's an option where you could put in money, and then also if you have the extra money, you can add it without the commitment to do so. Meaning that, for example, I was putting in $300 a month, but I built the policy so that way there's room for an extra $3,000 a year, and the room part means that the policy has a lot of tax advantages. It's growing tax deferred. When I take the money out, it's tax free, but up to a certain limit. And that limit in my case, in the situation, was $3,000 extra on top of the $300 a month. If I added $10,000 extra on top of it, it'd become a modified endowment contract now, meaning now it's a taxable contract and I'd have to pay taxes on the gains when I use that money. So I want to stay in the tax-free zone, and I'm funding it to, I'm maxing out the policy. So my first year I put in $300 a month. My second year, I put in $300 a month, plus I wrote a check for an extra $3,000 on top of that to max out the policy until the anniversary, until next year. Now, this is something a lot of people could do. Pretty much we would recommend you would put, starting off, between 5 and maybe 10% of your annual income into a policy. And I'm already doing my second policy now. My wife has a policy. So pretty much this is something that it's not a one-time thing where you just do it one time and that's it, you put it away. It's a continuous process. We have a 6-month review with all our clients, and it's very common for every 6 months or every year for a client to do a new policy to build up. So this is how clients can build up to the point where they can actually become their own source of financing. And you're right. It's not something where you can it's not an immediate thing where you could just put like in a few months and then just start financing, $100,000 homes on your own out of the policy. You need to make that, you need to earn that money in the policy for it to grow before you can finance that amount. In other words, you can't put in $10,000 and then borrow $50,000. More like you're going to be able to put $10,000 into the policy and then borrow out maybe half in the first year. But then it's a long-term game, meaning that as we're putting money into it, it's growing, it's compounding, it's earning interest and dividends, and it's growing. And now you have multiple policies. And then you can start, instead of financing, for example, the entire property, you can finance the down payment. And then if you can't have the down payment, then you can finance some of the renovation or some of the other closing costs. So the point is to get it integrated in your life, so that way you start financing smaller pieces as you go. It's almost like martial arts too. There's like a white belt strategies. You just start off a policy, you're putting in $300, $500 a month. And then the black belt strategy is you've created your own mortgage company within your portfolio. So you're lending money to yourself and paying yourself. That's like a black belt strategy. So we never want clients to kind of jump around. Take your time with it. And then I also highly recommend that clients understand this concept. It's a very confusing concept. It's counterintuitive, as we mentioned. So like there's a lot of free resources, such as The Bank on Yourself Revolution by Pamela Yellen, and the book called Becoming Your Own Banker by Nelson Nash. There's also tons of podcasts and YouTube videos about this concept. So I highly recommend you understand this concept, get the hang of it, learn what it is, and then reach out to us for free consultation and free financial analysis and all the other moving pieces.
Wow. Yeah, that's a lot there. So when do you decide how do you decide how much someone could borrow against? So say I start this thing, I just get it off the ground, I start real slow, and then maybe 5 years later, say I have $50,000 in there. How much can I borrow against that, and who decides, and how is that determined? How much of that I could borrow against while it's still growing?
Yeah. So at any point in time, once you start funding your policy, you'll have a cash value column and then a life insurance column. At any point in time, you could borrow up to 90% of the cash value column. So in your example, if you have $50,000 in the cash value column in that year, you could borrow up to 90% of that. So the insurance company will send you a check or direct deposit wherever you want it to go, up to $45,000. And then now you can pay that $45,000 on your own terms. You can pay it back next month, or you can pay it back over the next 10 years if you wanted to. You could finance it like $300 or $400 a month for however long you want it to be, as long as you pay it back within a reasonable time. Of course, since the policy is liquid, we recommend that you pay it back as soon as possible, so then you could turn around and borrow it again. Because if you borrow $45,000, you've kind of maxed out the limit of how much you could borrow. You still have the $50,000 cash value in there, but the insurance company is not willing to loan you more money on that. It's still going to grow. So as you're paying it back, then you kind of create that opportunity to borrow again and again and again. and you're doing so. And then now people always ask me, well, Sarry, why don't I just skip all of this? And then, I have $1 million in cash, let's just say, for example, and I just do all my real estate deals, cash deals, and I just keep it moving that way instead of having to go through whole life insurance and having to borrow and pay it back and do all this stuff. And then my response to that is, after, for example, if you have the whole life policy, you're borrowing against it. Let's say this happens over a 15-year period. Over a 15-year period, let's say you've accumulated 10 houses, you paid up. You own these 10 houses in cash now. You've got the appreciation on all these properties for each one over those years. You have your whole life policies all paid up. You got the appreciation in the policies too, and you have the liquidity too in the whole life policies to keep doing it over and over again. And you have life insurance to protect you and your family in case something happens to you throughout this journey. So you have all these additional benefits over and over again, compounding each other with the same dollars used. So it's not so much about buying insurance, rather it's repositioning dollars. So you're earning money in one hand and then you're going to spend it in the other hand. But before you spend it, you have it go through a whole life policy and then you take it from there and you spend it. So it's like a net that you can grip between the money you earn and the money you spend.
Awesome. So when you talk about up to 90%, so up to, I know is, touchy term. So up to, meaning like if everything looks great, you can get 90%. I mean, but why is it up to 90%, not just 90%?
Yeah, good question. Because you have the option.
1%, right?
It's because you have the option to pick how much you want. So for example, if you have $50,000 in there and you want to borrow money, you don't have to take out 90%. You could take out 1% if you wanted to, or 5%. So you could take out any percentage up to 90%.
Gotcha. Yeah. That's your choice. It's not like it has to be a certain qualifying asset.
Yeah.
Okay.
That's like a lawyer question you just asked me.
Yeah. Cool. So, and can this be done with any life insurance agent? Like, are you like the life insurance agent for for your clients, or do you like outsource it to different agents or what?
Yeah, so there's about 1,200 insurance companies in the US that sell whole life insurance. But this strategy that we're talking about only applies to 3 out of 1,200 insurance companies, meaning that there's certain requirements that they have to go through in order for you to apply these things. Number one, it has to be a mutual insurance company. It cannot be a stock-owned insurance company. So a mutual insurance company is owned by its customers, by the policy owners, and they would get back dividends based on the company's performance. So although dividends are not guaranteed, we only work with insurance companies who are mutually owned and have a proven track record of paying out dividends for over 160 years. So very solid companies that we're dealing with. And the second is there's something called a non-direct recognition feature. This is a part of the policy that in the example we already mentioned, if you have $50,000 in cash value and you borrow $20,000 from the policy, your policy continues to grow as if you've never touched it. That's non-direct recognition. The insurance company is not recognizing the loan that you have when paying you interest and dividends on your money. So it's continuing to grow and compound as if you've never touched it. If it was the opposite, if it was direct recognition, then they would recognize the loan and then probably decrease dividends and interest paid to you because of the outstanding loan. And the third part is the policy being properly structured with a paid up additions rider. This is a part of the policy you add to it to help increase the cash value over time, meaning that the policy itself is not 100% whole life insurance only. There's a cash value component in there that's building up interest and dividends, and it's doing so quickly with a paid up additions rider. So you need to make sure that the paid up additions rider is there, and you need to make sure the insurance company even has the paid up additions rider, because not every insurance company has this part. So it's a mutually owned company, non-direct recognition, and a paid up additions rider. And then you also want to make sure that the person you're dealing with is somebody who has the credentials of using whole life insurance in this way. It could be dangerous to go to any insurance agent and just say, hey, I want a whole life insurance policy so I could use for my real estate portfolio or whatever. Because it could have very small, there are some whole life policies that don't grow any cash value for 10 years. So you'll fund a policy $10,000 a year for 10 years, and then you won't have any cash value in it. It's because it was improperly structured. It wasn't structured the right way, and you need to make sure that doesn't happen to you. This also gave whole life insurance a bad rep in the industry, is that insurance agents were selling whole life insurance in this way, and then it kind of has this bad taste now where it's like a terrible investment or a terrible use of money. And it could be if it's structured the wrong way. So you want to make sure that the agent you're talking to is somebody who is competent and familiar with either the infinite banking concept or the bank on yourself concept, and they have further credentials, not just a life insurance license, but they also have they're part of the bank on yourself organization, or they are part of the infinite banking group, or some sort of credentialing group that specializes in the utilization of dividend paying whole life insurance.
Love that. Yeah, probably someone who's experienced with it would be great. So are you kind of the middleman then between your clients and then those insurance companies that practice this philosophy?
Yeah, I'm a broker. Exactly. So we're actually a brokerage firm, and we have the 3 insurance companies as brokers. We have more companies for different products. Like we still do Medicare. We still do other types of like term life insurance only. So we have like a portfolio of like 50 companies. 3 of them specialize in this concept. And client comes to us, for example, we do a free call, intro call, and then we do a free financial analysis. And then after the financial analysis, we'll do a personalized solution presentation. We'll do like a screen share over Zoom, share our screen and show like Mr. Client, Mrs. Client, this is what happens if you fund the policy. This is how much cash value build up. You mentioned you're a real estate investor. This is how it can connect well with it. So pretty much we use the financial analysis to build out the solution. And then after that, we would submit to one of the 3 companies, whichever one we feel is best. It could be both. It could be like, for example, a husband and wife, and the husband does one company and the wife does another company. Because we feel like based on their funding amounts and their goals, that would be a good match for them. And that's part of their overall financial solution. So pretty much we'd build it. And then after that, it would go through medical underwriting. It takes about 4 to 6 weeks. And this is probably the longest part about it. It takes about 4 to 6 weeks to get approved. Once it gets approved, then you get start funding the policy, monthly, annually, single premium cases, however we base it off of however the client wants to do it, actually. However the client wants to do it. And then we do 6-month reviews after that. And then, yeah, that's our process.
Wow. That's great. And obviously, everything sounds great here. Why is it, do you think, that not everyone's doing this?
Well, one, because people don't know about this. They don't know about how the moving pieces of whole life insurance and what it could do. And then also, like people who follow Dave Ramsey and Susie Orman, they know that whole life insurance is a terrible investment. And that's kind of like their paradigm now. It's that they believe that whole life insurance is a bad investment. And again, they're not familiar with Dave Ramsey and Susie Orman don't know about the whole life insurance, the infinite banking concept or the bank on yourself concept in the right way, actually, and how it is actually beneficial for a lot of people and how it can help them. And, people think too that it's an either or approach. So it's like either I invest in real estate or I save money on a whole life policy. And rather it's not. Whole life insurance is not an investment. It's a savings option, and it can be easily integrated with other investments. So for example, you don't have to choose between whole life insurance or your real estate. You could do both easily. You could fund the whole life policy, borrow against it, and then use for real estate. So it's a very connectable, integrated product that you could use, or concept actually, beyond a product that you could use within different areas of your life. And this is why I'm doing, podcasting. I've been a guest on over 100 shows talking about this concept. And I just started my own show called Thinking Like a Bank, where we show people the banking strategies that banks use, specifically using this strategy. And we have a lot of guests on that come on with a lot of real estate backgrounds and pretty much connecting these two together. So yeah, definitely the word is to spread the word and to get more people to know about this concept and how powerful it is. That's
great. Yeah. Love that. So when you talk about paying yourself back, yourself as the bank type of thing, whatever, do you pay interest when you pay that back? Say I have 50,000 in, I borrow 45,000 for a real estate deal. As I'm paying that 45,000 back, am I paying interest on that?
Mm-hmm. So a couple things happen. So one, when you borrow that money, you're borrowing from the insurance company. So the insurance company is going to charge you interest. The interest goes to the insurance company. And the insurance company, that's one of the sources of income, is to charge loans and to charge interest on loans. That's one of the sources of income. So you would pay the interest to the insurance company. Now people are always like, why would I do that? Why would I borrow my own money, pay interest to the insurance company when I could have just used my money in cash? Well, the answer to that is because while you were using that money and paying interest, your policy was also earning interest. And it's actually interesting, Rob, because when your policy is earning interest, it's earning compound interest and dividends. So it has a compounding effect. It's growing compound. When you're buying that money, when you're using it, you're buying it at typically 5% simple interest. So as you are paying for that money, you're paying at simple interest, but yet you're earning compound interest. And what happens is an arbitrage happens where you're growing more in your policy than the cost of capital. So for example, you would borrow, $35,000, you would pay it back. And then after you paid it back, your policy grew within it by, let's just say, an extra $10,000 over that 5-year period or however. But pretty much the point here is that your policy keeps growing to the point where you almost have a profit on that money within that policy. So your money grows for you in 2 different places, especially when you use it for real estate or other investments. You get the investment aspect of it, the profits of the investment. Hopefully you do profit from that investment, and you have the gains in the policy too. And of course, on a tax favored basis, the policy is growing tax deferred. And then in most situations, when you access that money, you're accessing it tax free because you've paid taxes on the money going in. And this this is most of the time. Sometimes it's a modified endowment contract, and the gains on it when you take the money out are taxable. And the client's aware of that. And sometimes that's intentional because of the other financial benefits of the policy. But it's disclosed with the client, of course, and their accountants on board, and they know about it.
Wow. That's great. So let's just, okay. So this is big, real estate. You work a lot with real estate investors, agents. Let's get into, like a home run story, or like maybe some client stories, and then we'll get into some of these closing questions.
Okay. Yeah, you want me to share a story?
Sure. Maybe just a typical real estate investor story, or maybe a home run story if you have one that you like in your back pocket, or, however you want to.
Okay.
Anything like, yeah, this person came to us with X amount of dollars and here's where they're at. I don't know.
So think of, and this is the way I was able to help this client, was thinking of this analogy beforehand. So think of when you go to like a large retail store, a large department store, and you see all those products, on the shelf, and those products are, like a vendor. So the company that you're buying from, that you go into the store, they would buy those products on credit. And then when they sell them, when you buy those products, they would pay the vendors, but typically there's a delay, sometimes like a 6-month delay or 1-year delay, and in paying them. And what happens is, and I don't want to name any stores, but these large department stores are pretty much storing large amounts of capital, billions of dollars in actually whole life insurance. It's called corporate owned life insurance, COLI. So they're saving them in COLI policies, earning compound interest on these policies. And then when it comes time to pay the vendors or creditors, they would pay them from the policy. They would take out loans and then pay them. And then the reason why they would do so is so that they can earn compound interest on billions of dollars. So it's an additional source of revenue for them almost, to just have the money sitting in a whole life policy and growing compound. In other words, they had the ability from the time they earned money to the time they had to pay that bill. They had a gap in between there, sometimes a 6-month gap, a 1-year gap, but in volume over and over again, they could actually make money with this money in between exchanging hands. And I was explaining this to a client who owns a distribution company. He does the same thing. He distributes to stores, and we were going through the review, and I was like, what's the longest time period you have? And he's like, I have sometimes 6 months until I have to pay the creditors. And I was like, okay, we could apply the strategy. And he had like millions of dollars in cash to just use it without earning interest on it, just in a bank account, in a regular business checking account. And I was like, okay, we can reposition these dollars and have them sit in a whole life policy instead. And then you can earn interest on them between you earning the money from your customers and then spending it to the vendors. You can earn interest on that. And that was the biggest case I've ever worked on. So that was pretty much the home run story that I worked on. And it was through that analogy of pretty much making money on money in the meantime of earning it and spending it.
Good stuff, man. Gotta love the home run story, the home run client. Big deal. That's great. So, okay, closing questions. And then we'll get to your contact information, any other things, and then any other things you'll want to share. What's your favorite book?
Favorite book is, Mindset by Carol Dweck, for sure. Yeah.
That's a very common book. That's one of those that I have not read. I try to read the ones that are like everyone talks about, and like, just so that I can, relate to people like you who bring it up. But I have not read that one, although I have heard the title quite a bit.
Yeah, I recommend it. Yeah, it's a really good book. It's probably my favorite book on mindset and like motivation, definitely, for sure.
Yeah, good stuff. She has a TED Talk on it too. I think I've heard the TED Talk.
Yeah.
Sweet. What are your hobbies?
Hobbies. I like to go to the gym, work out. I like to run outside, but the problem is I live in Chicago, and Chicago winters are tough. So pretty much haven't been running all winter, just going to the gym. But yeah, I love to run outdoors.
That's a good one. I got into that last year with COVID, with the gym shutting down.
Yeah.
A little pivot there. If you had to point to one thing you either learned, developed, or were just born with that makes you successful, what would that be?
Curiosity. Definitely just asking questions and just being curious about everything.
Good one. And who's someone you're wanting to meet?
I'd like to meet Denzel Washington, actually.
He's a good one,
Yeah.
what are you currently focusing on, and how can the listeners help you?
Yeah, focusing on right now, building up the podcast base. They can help me by visiting the podcast. It's called Thinking Like a Bank. We've done 6 episodes. 5 of them are up now, and we're pretty much going to do 1 to 2 episodes every week now. Yep.
That'll be great. I'll have to check it out.
Yeah, and I'd like to have you on too as a guest if you're open to it.
Yeah, let's do it.
Yeah.
Love that. I've never been asked to be on someone else's podcast during the podcast. Freaking back up, man. That's great. Bonus question. What's your favorite movie?
The Prestige, for sure.
And how can people learn more about you? Any contact info?
Mm-hmm. So they can go to our website. It's finassetprotection.com, FIN assetprotection.com. And then I'm pretty active on LinkedIn, Sarry Ibrahim on LinkedIn. And yeah, those are the 2 best ways to contact me and learn more about what we do.
Nice. All right, man. Well, hey, I learned a cool new strategy. I'm excited about this. I'm going to talk to some people about it. And
sorry. I want to
this. Tons of great value with listeners. One last thing.
Yeah, I want to add in, if listeners reach out, I'll throw in a free copy of the book, Becoming Your Own Banker. I'll just send it to them for free. They don't need to call. They don't need to schedule an appointment. Just if they want to reach out and learn more about this concept and just want a free book, by all means, go to finassetprotection.com and I'll send you a free copy of that book.
Oh, man, that's a sweet value. All right, listeners, let them know real estate in the tri-state. You heard them here. So cool. Thank you so much for being on. Learned a ton. It was great.
Thanks, Rob. Appreciate it. Thanks for having me on.
All righty. And with that, we are out.
All right, guys. Thank you for listening to today's episode of Real Estate in the Tri-State. We want to encourage all of our listeners to send in any and all real estate questions to us at rottlerpodcast@gmail.com. More details in our show notes.
And as always, let's have a great day, folks.